Welcome to ZZ Financial. We are dedicated to providing the most accurate, valuable, and timely information and analysis.
And hello, everyone. It's Monday, August 18th. Here on the East Coast of the United States, it's 9 p.m., which means it's 6 p.m. out on the West Coast. We've just wrapped up a truly fascinating stretch of global financial news, packed with big moves in stock markets, shifting currency dynamics, and some really intriguing corporate stories. Today, we're taking a deep dive into the latest economic signals and market chatter that's shaping our world. To kick things off, what's been the most compelling story grabbing your attention in these recent market movements?
For me, the standout narrative this past week, maybe even longer, has been the extraordinary resilience and almost defiant rise of Japanese equities. We've seen Tokyo's benchmark index not just hit new record highs, but actually surpass its previous peak multiple times. Just for context, it closed at 43,378 yen on August 15th, and then boom, again at 43,714 yen on August 18th. This is quite remarkable, especially when you consider that, well, some initial earnings reports for the April-June quarter actually showed profit declines. It feels kind of counterintuitive at first glance, doesn't it?
It absolutely does, yeah. When current earnings are dipping, a surge like that, it can feel a bit like trying to look into a crystal ball, you know?
Yeah.
So what's driving this incredible upward momentum? What makes this logic, quote unquote, so compelling for investors to essentially look past what's happening right now and focus so much on the future?
That raises a really important point, and it's where the market's forward-looking nature truly comes into play. What's fascinating here is that despite, the first profit decline in 3 years for that April-June quarter, investors are clearly buying on next-term prospects. This isn't just a hunch or wishful thinking. The market is specifically looking at some pretty robust forecasts for fiscal year 2026. Analysts are already anticipating double-digit profit growth for that period.
Double-digit growth. Wow.
Yeah, and the core argument here, it revolves around valuation and easing uncertainties. If you look at the price-to-earnings ratio, the PE ratio for the main Japanese index based on those anticipated 2026 earnings, it's sitting around 14 times.
Okay, 14 times. What does that mean exactly? Is that high?
Low. Well, to put it simply, for every dollar of anticipated future earnings in 2026, you're currently paying about $14 for the stock. Now, if you compare that to other major markets where you might be paying, say, $20 or $25 for that same dollar future earnings, well, Japan suddenly looks like a significant relative bargain.
Ah, okay. So it's cheaper based on future expectations.
Exactly. And importantly, that April-June earnings season, while showing a decline, was not as bad as feared. This means that analysts' earnings per share forecasts, the EPS forecasts, they're actually stabilizing rather than continuing to fall off a cliff.
Right. So not great, but not a disaster either.
Precisely. And another key piece. Clarity around U.S. tariff-related uncertainties has really accelerated these discussions about a 2026 recovery. Usually, conversations about next fiscal year prospects don't really start gaining serious traction until much later in the year, maybe October, November. But this year, the market kind of jumped the gun, driven by these converging factors.
Okay, so this forward-looking confidence is driving the stock market. But what does this all mean for the broader economy in Japan? We also saw some really strong GDP numbers come out, right? Are those numbers confirming this optimism, or is there maybe a disconnect?
No disconnect at all. Actually, the strong macroeconomic data strongly underpins this market optimism. It provides a solid foundation. The Cabinet Office announced stronger than expected preliminary GDP data for the April-June quarter. It showed a robust domestic economy that's certainly defying some earlier, more pessimistic forecasts. The annualized growth rate for Q2 was a solid 1.0%. That significantly surpassed forecasts that were closer to maybe 0.3%.
1% versus 0.3. That's a big difference.
It is. And even more significant, Japan's nominal GDP, that's GDP measured in current prices, without adjusting for inflation, it grew at an annualized 5% rate to a record 633 trillion yen. And what's really telling, I think, is that the GDP deflator.
Okay, hold on. Nominal GDP, GDP deflator. These terms can sound a bit technical. For us, the informed but maybe not always jargon-fluent listener, what does that really tell us about Japan's economy? Why does it matter so much to foreign investors?
All right, good question. Let's break it down. Nominal GDP growing strongly means the overall size of the economy, in yen terms, is expanding rapidly. And the GDP deflator. Think of it as a key measure of price changes across the entire economy, not just for consumers like the CPI. The fact that this deflator has risen for 11 straight quarters, that's a big deal.
11 quarters. Wow, so prices are consistently going up.
Consistently. If we connect this to the bigger picture, it strongly suggests Japan is genuinely escaping that long, persistent period of deflation falling prices that plagued it for decades.
Okay, escaping deflation. That sounds important.
It's huge. For decades, Japan struggled with falling prices, which stifled economic growth, discouraged investment, and made it incredibly difficult for companies to increase their profits. But now, with sustained inflation and nominal GDP growth consistently exceeding 3% for several years, these are incredibly strong signals. They tell global investors that Japan is no longer stuck in that deflationary trap. It's entering a new economic chapter.
So it's like a fundamental shift in the narrative for Japan.
Exactly. It's not just a statistical win. It's a fundamental re-rating for Japanese assets. This shift makes Japanese companies look much more attractive because, well, they can now grow revenues and profits more easily in a rising price environment. It transforms Japan from a market often viewed, maybe unfairly, as a value trap into a legitimate, compelling growth story for global investors.
And we've seen this play out directly in specific companies and sectors, right? You mentioned earlier things like SoftBank Group and even the big financial stocks. They must be benefiting directly from this economic shift.
Absolutely. We've seen very direct and tangible impacts. Financial stocks, especially the major banks like MUFG, they've seen significant gains. MUFG, for example, rose a remarkable 6% to hit a record high.
6%, just like that.
Yep. And this is on the back of clear expectations that this newfound economic strength will eventually prompt the Bank of Japan to gradually raise interest rates. Higher rates directly improve bank profitability because, well, banks can earn more on their loans.
Right. The spread improves.
Exactly. And then there's SoftBank Group. It surged 6% itself, also hitting a record high. Remarkably, it's contributed nearly 1,000 points to the main index's overall rise just since late July. That shows the power of specific corporate drivers within the broader market.
Wow. One company having that much impact.
So these aren't just broad market movements. They're definitely driven by specific company performance and sector-specific catalysts that are directly tied to Japan's evolving economic story.
Okay, here's where it gets really interesting for me. This buying Japan trend, it seems to be influenced by what's happening or expected to happen in the U.S., specifically these expectations around a preemptive U.S. rate cut. How are these two seemingly separate stories, the Japanese market and the U.S. Federal Reserve, so intricately connected? It feels like an unexpected link for many of us.
It's a crucial link, and it truly highlights just how interconnected global markets are now. Japanese stocks are currently outperforming U.S. equities quite significantly. Tokyo's benchmark index has clocked a substantial 6% gain in under 3 weeks. That dramatically outpaces the S&P 500's more modest 2% rise over the same period.
6% versus 2%, that's a big difference.
It really highlights where global capital is flowing right now. And the driving force here is the perception that a preemptive U.S. rate cut.
Preemptive meaning before things get really bad, like heading off a recession.
Exactly. A cut designed to avert an economic downturn before it fully materializes. Kind of a stitch-in-time-saves-9 approach by the Fed. The market believes such a move would lead more capital to flow into Japanese stocks.
Why Japan specifically, though?
Well, historically, Japanese equities have done very well during such periods. For example, if you look back at the U.S. rate cut cycle since 1989, there were 3 that were clearly preemptive: 1995, 1998, and arguably the current 2024 cycle. In those instances, the Japanese index actually outperformed the S&P 500 by anywhere from 2 to 10 percentage points in the year following those cuts.
Interesting. So there's a historical pattern.
A powerful historical precedent that investors are clearly paying attention to. The key insight here is the market's subtle bet. It's not just if the Fed cuts, but how and why. A preemptive gradual cut suggests the Fed is confident in guiding the U.S. economy to a soft landing.
Okay.
This boosts global demand and especially benefits export-heavy Japan. It creates a kind of Goldilocks scenario, strong U.S. economic conditions without a sharp detrimental yen appreciation.
Ah, the Goldilocks scenario. Not too hot, not too cold.
Exactly. This smart money move anticipates a less volatile, more growth-friendly environment, particularly for certain international markets like Japan.
So a gradual U.S. rate cut is good for Japanese stocks. That almost sounds counterintuitive, because doesn't a weaker dollar, which you might expect if the U.S. cuts rates and Japan doesn't, usually weigh on Japanese exports, making their goods more expensive?
That's a very perceptive question, and it's a common concern. Logically, you'd think a weaker dollar would hurt. But the argument analysts are making is that these preemptive gradual cuts avoid a sharp yen appreciation. That's the key.
Okay, so it's about the pace of the change.
Right. It allows Japanese stocks, especially those export-reliant global cyclical stocks, to benefit from improved U.S. economic conditions without facing significant damaging currency headwinds.
Global cyclical stocks, you mean companies sensitive to the global economy, like manufacturing?
Exactly. Think manufacturing, shipping, maybe even luxury goods, companies whose fortunes rise and fall with global growth. Japan has many of these. And history supports this idea. If you look back at 1995, the dollar actually rose 20% against the yen after the preemptive cut.
It rose. Okay, that's surprising.
And in this current 2024 cycle, the yen has actually weakened by about 3% relative to the dollar, despite the Fed signaling cuts. So it seems the market is focusing more on the overall health of the global economy, which these gradual cuts are seen to support, rather than solely on the immediate currency impact. It's a nuanced stance.
Okay, that makes more sense. It's not just the exchange rate in isolation. Now, we also saw specific companies like Sanrio, the creator of Hello Kitty, performing incredibly well. That's a brand everyone knows. How does it fit into this larger economic picture beyond just, being cute?
Right. Sanrio stocks surged an impressive 7%, marking a staggering 40% rise over just 5 days. It hit a new all-time high.
40% in 5 days.
It's remarkable, and it really illustrates a broader trend. Investors seeking companies with high growth expectations that are also perceived as less susceptible to things like U.S. tariff policies or global economic slowdowns. Sanrio's strong character business, Hello Kitty is everywhere, right? It has true global appeal. That generates consistent licensing and merchandise revenue. Combine that with upward earnings revisions for the company, and you've got intense investor interest. Even though its forward PE ratio is around 43 times.
Whoa, 43. That sounds really high compared to the 14 you mentioned for the overall market.
It is high, absolutely. But it's a testament to the enduring global appeal of Japanese intellectual property, or IP. Investors seem willing to pay a premium for that consistent growth and perceived immunity from trade tensions, especially when it's tied to strong, universal brands. Predictable revenue streams are highly valued in uncertain times.
So, iconic brands equal perceived safety and growth.
In this case, it seems so. It signals that value.
But with all this bullishness, these rapid rises, are there any signs of overheating? Should investors be cautious? It feels like things are moving very fast.
You're absolutely right to ask about caution. There are definitely signs flashing yellow, maybe even red. The main index's deviation from its 25-day moving average, for example, it exceeds 6%. That often signals overbought conditions, suggesting a correction might be due.
Okay, a technical warning sign.
And similarly, the advanced decline ratio for index-listed stocks has surpassed 150%. That's another indicator typically associated with an overheated market. Some analysts, like Yusuke Mayama from NLI Research Institute, are still predicting caution around these record highs. They're suggesting that while momentum is strong, the market might be getting a bit ahead of itself in the short term.
So the experts are divided.
Well, despite these technical warnings, what we're seeing is that foreign short-term investors are continuing to buy index futures. It indicates that fear of missing out, FOMO. FOMO is still a very strong driving force in the market right now, pushing prices higher. It's a classic battle. Technical indicators screaming caution versus pure market momentum driven by investor psychology.
Fascinating. Okay, let's shift our gaze now to the intricate world of global currencies and interest rates. They're so interconnected with these stock movements we've just discussed. The yen, in particular, has been weakening quite a bit. What's the primary force behind that, and what are the ripple effects we should be watching?
Right. The yen weakened for the first time in 3 days recently, trading around 147.890 yen per dollar in New York. The primary driver here is that widening interest rate gap between Japan and the U.S. that we touched on earlier. We saw recent U.S. inflation data, specifically the July Producer Price Index, the PPI. It came in higher than expected.
Higher inflation in the U.S. Okay.
That immediately reignited inflation concerns among market participants, and crucially, it significantly reduced expectations of aggressive Federal Reserve rate cuts in September. So the U.S. rates potentially staying higher for longer, and Japanese rates still relatively low, the incentive is clearly there to sell yen and buy dollars to capture that higher yield.
So if I'm understanding correctly, higher U.S. inflation means the Fed might not cut rates as much or as quickly as people initially thought. That makes the dollar more attractive than the yen for investors seeking better returns, and that's why the yen is weakening.
That's a very clear summary of the core dynamic.
Yes.
The higher U.S. PPI reading definitely dampened hopes for a major Fed rate cut in September, which would have narrowed that interest rate gap and made the yen more appealing. This just reinforces the view that the Japan-U.S. interest rate difference remains wide, favoring selling yen and buying dollars. And market surveys reflect this. One recent Forex survey showed a substantial 78% of market participants now expect only a 0.25% Fed rate cut in September.
Only 0.25%.
Right, and only a tiny 5% are predicting a larger 0.50% reduction. So the consensus has clearly shifted towards a more restrained Fed, meaning less aggressive cuts, which naturally strengthens the dollar relative to the yen.
Okay. And what about U.S. long-term interest rates, like Treasury yields? How are they reacting to these inflation concerns and the shift in Fed expectations? Are they climbing too?
They are indeed climbing in response. U.S. long-term bond yields have been trending higher. For instance, the 10-year U.S. Treasury yield closed recently at 4.33%. This indicates that speculation about significant, deep Fed rate cuts has notably waned, leading to continued bond selling. When investors expect fewer or smaller rate cuts, they demand higher yields for holding long-term bonds. They want more compensation for locking up their money.
Makes sense.
Furthermore, the University of Michigan's preliminary consumer sentiment reading for August also indicated rising inflation expectations among consumers themselves. That further fuels this trend of higher bond yields as investors seek compensation for the potential erosion of their returns by future inflation.
So, multiple factors pushing U.S. yields up.
Correct.
Now, on the other side of this coin, we have the Bank of Japan. How does their stance fit into this puzzle? Are they also looking at raising rates? Could that potentially counteract the yen's weakness against the dollar?
Well, while the U.S. rate outlook is certainly weighing on the yen, the possibility of additional rate hikes by the Bank of Japan, the BOJ, is also very much in play. It acts as a kind of counterbalance. Japan's stronger than expected Q2 GDP data, which we discussed earlier, combined with the minutes from the BOJ's July policy meeting. Those minutes hinted at a possible end to its long-standing wait-and-see stance on monetary policy.
Ah, so the BOJ might be getting ready to move too.
Markets are interpreting it that way, yes,
Yeah.
as somewhat hawkish. This factor has actually limited further significant yen losses. It creates that sort of counterbalancing force you mentioned. Investors see the U.S. rates pulling the yen one way, but potential BOJ action pulling it back the other. It leads to that dynamic tug of war.
So, if Japan's economy is strengthening and the BOJ might raise rates, that could theoretically strengthen the yen, right? It's like that tug of war you mentioned, pulling the currency in different directions. But what does that mean for the Japanese stock market? Didn't we say earlier it kind of benefited from a weaker yen?
That's a great analogy, and you're spot on. It certainly is a tug of war. However, with U.S. yields continuing to rise, partly due to ongoing U.S. fiscal concerns and robust economic data there, the potential for really significant yen appreciation is being kept in check. This delicate balance actually allows Japanese stocks to continue benefiting from those improved U.S. economic conditions we talked about, because a stronger U.S. economy generally helps global trade without the major drag of a sharply appreciating yen that would really hurt Japanese exporters.
So the yen isn't strengthening too much, which is good for stocks.
Exactly. The tug of war isn't necessarily resulting in a net loss for Japan's markets right now. It's more like a constrained movement in the yen, allowing the broader economic benefits to filter through. It's a sort of beneficial equilibrium, at least for now.
And of course, in this interconnected world, it's not just economic shaping sentiment. Geopolitical winds are always blowing. What's been the impact of the latest U.S. Ukraine talks on these global markets? Are investors still on edge about that situation, or is it being somewhat shrugged off for now?
Interestingly, the U.S. Ukraine summit on August 18th, where President Trump pledged long-term U.S. support for Ukraine's security guarantees, it actually had a rather limited immediate market impact.
Really? Limited impact.
Relatively speaking, yes. While President Trump did reveal plans for a potential three-way summit involving President Putin and President Zelensky, market expectations for a swift ceasefire agreement remain quite low. So while a degree of caution certainly persists regarding the geopolitical landscape, it hasn't translated into significant market volatility or a major flight to safety across the board. In fact, the general sentiment for the yen, which is typically considered a low-risk currency and tends to strengthen during times of global uncertainty.
Right, the safe haven currency.
Is actually for it to face selling pressure as investor sentiment turns perhaps cautiously more bullish on the hopes for eventual peace and stability, however distant. The market appears to be prioritizing economic signals over these geopolitical ones in the immediate short term, though that balance can always shift quickly.
So, the market is somewhat shrugging off geopolitics for now, but all eyes are clearly still fixed on the Federal Reserve. What's the single most important event coming up that everyone is watching for clues on future policy? And what could potentially be the game changer in that announcement?
The critical focus, without a doubt, is on Fed Chair Powell's highly anticipated speech at the Jackson Hole Economic Symposium. This year's symposium runs from August 21st to 23rd, with his key speech specifically scheduled for the 22nd.
Jackson Hole, always a big one.
It holds significant weight. As we saw last year, Powell effectively used this event to signal a rate cut, which sent very strong signals to the market. So his remarks this year are keenly awaited. Market participants will be parsing every word, looking for any nuances, any hints about the Fed's future path. The market is largely priced in a September rate cut, but the precise wording, the tone from Powell, that will be absolutely crucial for setting expectations for the rest of the year.
Okay, but what could Powell possibly say that would really move the needle? Especially if, like you said, the market already expects a rate cut. It feels like the big reveal might have already happened.
That raises an important point, and it's where the nuance really lies. The if of the cut might be priced in, but the how much and why are still very much up in the air.
Ah, the details.
Yeah, exactly. If he signals an aggressive rate cut, maybe hinting at more than the market currently expects, or a faster pace, it could potentially lead to sharp yen appreciation, which, as we discussed, could become a headwind for Japanese stocks.
Right, hurting exporters.
On the other hand, if he maintains a very cautious, very data-dependent stance without providing any clear guidance on the timing or magnitude of future cuts, that could lead to market stagnation, maybe disappointment. Sort of wait-and-see fatigue could set in.
Okay, so uncertainty isn't good either.
And there's another angle. Some analysts even warn that if the Fed appears to be yielding to political demands for rate cuts, especially maybe ahead of an election, that could raise serious concerns about central bank independence.
Oh, interesting point.
That could potentially trigger dollar selling as trust in the Fed's autonomy wavers. So it's a really delicate balancing act for the Fed. It makes the near-term outlook somewhat unpredictable, despite those widespread expectations for some kind of cut in September. The specifics of his language, the rationale behind the Fed's stance, that's where the real market reaction will likely come from.
Fascinating. Okay, beyond the big picture indices and central banks, we've seen some really interesting stories bubbling up in specific sectors. Let's start with copper. It's such a foundational material used in everything from wiring to electronics, and its price is staying stubbornly high, right? Hovering near $10,000 per ton. Why is that? What's going on in the copper market?
Copper prices are indeed hovering near that $10,000 per ton mark. That's more than 20% higher than their lows back in April. The key factor driving this is a severe and persistent ore shortage, raw copper ore. Despite expanded ingot production capacity, particularly in China, which is the world's largest consumer, the actual ore production just hasn't kept pace with this growing demand.
So demand is up, but supply isn't keeping up.
Exactly, and supply has been hit by disruptions. We've seen significant incidents like a tunnel collapse at Chile's El Teniente mine, which is a major producer. And then there's the continued closure of Panama's Cobre Panama mine due to environmental protests. That one mine alone accounted for over 1% of global copper production.
1% from just one mine. Wow.
So its prolonged closure has a tangible, widespread impact on supply. The fundamental supply-demand imbalance, really exacerbated by these disruptions, is keeping prices elevated. It points to a deeper structural issue in the commodity supply chain.
So mines are having trouble getting enough raw copper out of the ground, and that's impacting even the companies that process it, the smelters who turn ore into usable metal. Sounds like a squeeze across the entire chain.
That's precisely it. It's creating a significant squeeze further down the supply chain, a real pain point for the industry. Smelting companies, the ones turning raw ore into ingots, they're facing severely squeezed margins. The processing fees, which maybe once made up about 20% of the ingot price back in the early 2000s, they're now down to a meager 1%.
1%. Down from 20. That's drastic.
It is. And in some spot markets, we've even seen a rare inversion where the price of the raw ore has actually surpassed the price of the refined ingot.
Wait, the raw material costs more than the finished product? How can they even operate?
It means smelters are struggling immensely. Japanese smelters like JX Metals and Mitsubishi Materials are even considering production cuts because of these worsening or procurement conditions and vanishing profitability.
Production cuts. That could make the shortage worse.
Exactly. If we connect this to the bigger picture, demand for copper is growing, right? Think electric vehicles, data centers. An EV uses significantly more copper than a traditional car. These potential production cuts could exacerbate the existing supply shortages, which fundamentally supports strong copper prices in the medium to long term. Copper seems to be facing persistent structural supply challenges.
Okay, from foundational metals like copper, let's turn our attention to another essential industrial building block, benzene. Its price movements offer a different lens into global demand and supply chains. We saw benzene prices rise recently. What's driving that, and how does it connect to the broader economic narrative, especially with those lingering concerns about global economic uncertainty?
Right. Asia's benzene prices rose for the second consecutive month in August, up about 1% to $770 per ton. This was largely driven by the upward trend in crude oil prices. Benzene is derived from crude oil, so it's a key feedstock.
Ah, so it follows oil prices.
To a large extent, yes. And crude oil prices, in turn, rose due to a couple of main factors. First, eased economic slowdown concerns after some recent U.S. tariff negotiations provided a bit of relief. And second, expectations of reduced oil supply stemming from strengthened U.S. sanctions against Russia.
Okay, so supply and demand for oil pushing benzene up.
Yes, but it's interesting. While the oil price is pushing it up, the actual global demand for benzene itself remains somewhat weak. That's due to broader economic uncertainty and maybe some impact from U.S. high tariff policies introduced back in April. However, for buyers in Japan, the weaker yen in July led to a significant surge in the yen-denominated price. It was up 5%, even though the dollar price only rose 1%.
Ah, the currency effect again.
Yeah.
Making it more expensive locally.
Exactly. So currency movements are playing a big role here too, amplifying the price increase for Japanese businesses.
Now let's talk about something many of us can relate to directly, air travel. There's a fascinating story about airfares between Tokyo and Seoul. What's happening there? Why such a dramatic change in what's normally a very busy, popular route?
Yeah, this one is quite striking. What's fascinating is the stark contrast in airfare dynamics. Round-trip airfares between Tokyo and South Korea have apparently hit a 6-year low. They've dropped by a massive 56% compared to August 2023.
56% drop. That's huge. Why?
It seems to be a confluence of factors, partly attributed to, believe it or not, rumors of an impending earthquake in Japan circulating on social media.
Earthquake rumors affecting flights.
Yeah.
Seriously.
Apparently so. An unexpected but significant demand dampener. Add to that the intense summer heat in Japan, making travel less appealing for some, and simply fewer South Korean travelers choosing to fly to Tokyo recently. So airlines facing reduced demand on these key routes and trying to keep their planes full, they responded strategically by lowering prices to attract Japanese passengers and fill those empty seats.
Wow, a classic example of supply and demand reacting rapidly to external shocks and, well, social media rumors. So it's significantly cheaper to fly to Seoul from Tokyo now. That's great news for some travelers. But I also heard that regional flights, say from Fukuoka to Seoul, are actually more expensive. How can that be? It seems counterintuitive, same destination, different starting points, opposite price trends.
This raises an important question about market segmentation and competition within the travel industry. It's not uniform. While those main Tokyo-Seoul flights are cheaper due to high competition and those demand factors we just discussed, regional routes like Fukuoka-Seoul actually saw a substantial 36% price increase.
Up 36%, while Tokyo is down 56%.
Exactly. And the reason is pretty straightforward. Regional routes typically have far fewer flights and significantly less price competition compared to major hubs like Tokyo, which have multiple airlines vying for passengers and higher flight frequencies. Plus, many post-pandemic flights haven't even resumed for some of these regional routes yet. This creates a sort of supply shortage on those specific routes, driving up prices.
Lack of competition and fewer seats.
Right, so while South Korea remains a popular destination overall, for travelers in regional parts of Japan, it has ironically become a country near yet far, simply due to these diverging market dynamics. It really shows how localized supply, demand, and competition can create vastly different pricing.
Fascinating. Okay, we also saw some interesting company-specific news moving beyond commodities and travel. Let's delve into what's happening with Goodart and Medley. These are very different types of companies, one in pharmaceutical access, the other in online medical services. What do their recent moves tell us about broader trends in healthcare tech?
Indeed. Let's start with Goodart's holdings. Their stock surged. Well, it temporarily surged an astounding 41.5% after announcing a strategic partnership with the Danish pharmaceutical giant Novo Nordisk.
Novo Nordisk, the makers of Wegovy and Ozempic.
The very same. Through Goodart's platform, they will now offer Novo's popular obesity treatment drug Wegovy and the diabetes drug Ozempic for set price $499 per month, specifically to uninsured patients.
$499 for the uninsured. That's still a lot, but much less than list price, right?
Significantly less. This deal is expected to really boost GoodRx's revenue, as patients will be able to use the platform to get prescriptions filled at over 70,000 pharmacies nationwide. It highlights this evolving pharmaceutical distribution model, trying to bridge the gap in patient access, especially for those without insurance facing incredibly high drug costs.
So using tech platforms to tackle drug pricing issues.
Exactly. And adding to the positive sentiment, Novo also received additional FDA approval for Wegovy as a treatment for a specific type of liver disease, further boosting confidence in the drug's broader market potential and, by extension, the strategic value of this partnership with GoodRx.
Okay, interesting development there. Now, what about Medley? Their story sounds a bit different.
Quite different. Medley, which is an online medical service provider in Japan, announced it's tripling its share buyback limit to 3 billion yen. That increases the maximum shares it can repurchase to about 1.05 million, or roughly 3.3% of its outstanding shares.
Tripling a share buyback? Why now?
Well, this move comes right after their first half 2025 net profit dropped by a steep 68%.
Ouch, 68% drop.
Yeah, and consequently, their stock price plummeted 17% on August 15th. It was one of the largest declines on the Tokyo Stock Exchange prime market that day. The company stated the reason for the buyback was, and I quote roughly, to implement flexible capital policies, respond to current buyback conditions and stock market trends, and strengthen shareholder returns.
So, buying back shares. It's like a signal to the market that they think the stock is cheap, and trying to support the price after that big drop.
That's the classic interpretation, yes. It's a common move by a company to try and stabilize its stock price and signal confidence to investors, especially after a significant profit hit. A share buyback effectively reduces the number of outstanding shares, which can boost earnings per share mathematically, at least, and, in theory, support the stock price. It signals that management believes the stock is undervalued and shows commitment to shareholder value even amidst challenges.
Got it. A defensive move, but also a signal. And what about the solar energy sector? We saw a company called Sunrun make a big move. Its stock surged 19%. How are government policies and regulatory clarity impacting this particular industry? Solar often seems very dependent on incentives.
Sunrun, which is a prominent U.S. solar panel company, saw its stock surge that significant 19% after new U.S. Treasury guidelines were released. These guidelines specifically clarify the eligibility criteria for solar-related tax incentives under the Trump administration's tax cut law.
Clarity on existing rules.
Exactly. This clarity effectively reduced a great deal of policy uncertainty that had been hanging over solar projects. For investors, that uncertainty was a major risk. This led directly to increased buying interest from investors. For a capital-intensive sector like solar, where companies plan huge, long-term projects based on expected returns over many years, policy stability is absolutely crucial.
Right, you need to know the rules of the game won't change halfway through.
Precisely. When tax credits or incentives are unclear or seem like they could disappear, it creates real hesitancy for investment. In fact, RBC Capital Markets upgraded Sunrun's rating to buy, specifically because of this improved regulatory outlook. It really highlights how regulatory clarity, or the lack thereof, can directly and dramatically impact investor confidence and stock performance, especially in capital-intensive sectors like solar. Sometimes, clear rules are just as valuable as new funding.
That makes a lot of sense. Stability matters. Finally, we're seeing some unique corporate strategies playing out with Zensho Holdings, known for Sukiya beef bowls and Hama Sushi, and Yamazaki, a machine tool maker. What are they doing that's innovative or noteworthy in terms of their financial and listing strategies?
Let's start with Zensho Holdings, the parent company behind those popular food chains. They announced their first ever issuance of 50 billion yen in something called bond-type preferred stock.
Bond-type preferred stock, what is that exactly?
It's quite an interesting financial instrument. These stocks offer a fixed annual dividend, around 4 to 4.5% for about 5 years. Crucially, they come without voting rights and without common share conversion rights.
No voting, no conversion.
Okay.
Yeah.
The funds raised from this 50 billion yen is a significant amount will be channeled into strategic initiatives like opening new stores and making digital investments, both vital for a growth-oriented consumer business like theirs. Now, what's truly unique and beneficial for Zensho here is that, for accounting purposes, this preferred stock is recognized as equity, not debt.
So it looks like equity on their balance sheet.
Correct. This allows them to raise significant capital without appearing to take on more debt, which keeps their financial ratios looking healthier. And importantly, it avoids dilution for existing common shareholders because there's no right for these preferred shares to be converted into common shares later on.
Ah, so they get cash for growth. It counts as equity, but it doesn't water down the ownership of current shareholders. That sounds pretty savvy.
It's a very savvy financial maneuver, especially for growth-oriented companies looking to expand aggressively without over-leveraging or diminishing the value for their current owners.
Okay, interesting. Now, what about Yamazaki, the machine tool maker? They're listing on a different exchange.
Yes, Yamazaki, which manufactures machine tools and auto parts, announced a rather unique move. They will list on the Fukuoka Stock Exchange on August 25th.
Fukuoka, not Tokyo. Why?
This decision comes in direct response to stricter listing maintenance standards that were recently implemented on the main Tokyo Stock Exchange. Their goal with this move seems multifaceted. One, they want to enhance their recognition specifically in the Kyushu region where Fukuoka is located. Two, they hope to attract more individual investors from that particular area. And three, critically, they aim to improve their market capitalization of circulating shares, the shares readily available for trading, which currently falls short of the new, tougher Tokyo Stock Exchange requirements.
So they're moving exchanges partly because the rules in Tokyo got tougher for them, and they see an advantage in a regional exchange.
Essentially, yes. It's an interesting example reflecting how companies adapt to regulatory changes. They're seeking specific regional advantages and maybe a more suitable investor base to support their growth and maintain their listing status. In a world of increasingly stringent exchange rules, finding a more suitable listing venue can be a strategic move to optimize capital structure and investor relations for specific business goals.
Okay, really interesting corporate maneuvers there. Let's quickly touch on other parts of the world now before we wrap up. We've had updates from European markets and Singapore. How did they fare amidst all these global developments, especially with the shifts we've seen in Japan and the U.S.? Are they echoing the same trends or charting their own course?
European stock markets showed some slight gains around August 15th. This was primarily driven by positive movements spilling over from Asian markets earlier in the day. There was also a sense that recent earnings reports from major European companies, while not spectacular, were perhaps better than feared.
Better than feared seems to be a theme.
It does. Buying was particularly strong in resource-related and material stocks in Europe. This was partly due to expectations of potential government stimulus after some weak economic indicators emerged from China, suggesting Beijing might step in to support its economy. Europe is quite sensitive to that.
Right. China's health impacts Europe.
However, by August 18th, European stocks saw declines. The STXX 600 index, a broad measure, was down about 0.2%. This seemed mostly due to profit-taking after recent highs and just lingering uncertainty over the Ukraine situation. Financial stocks like Germany's Commerzbank, for instance, saw a notable selling pressure, showing continued caution in the banking sector there.
Okay, so a bit mixed in Europe. What about Singapore?
Singapore stocks fell for the third consecutive day on August 18th. The main ST index dropped about 1.01%. This decline was largely triggered by the release of July's non-oil export data. That data showed a significant decline of 4.6% year-on-year.
Down 4.6%. That bad?
It was a sharp reversal from the growth they saw in June, and it came in well below market expectations. This substantial drop was partly due to sharp declines in exports of pharmaceuticals and petrochemicals, which are key components of Singapore's export-driven economy. It really highlights how export-dependent economies like Singapore are particularly susceptible to shifts in global trade and demand fluctuations. It reinforces that interconnectedness of supply chains and global demand we keep seeing.
Yeah, very exposed to global shifts. We've discussed U.S. tariffs a few times throughout this deep dive, often in the context of their impact on Japan or specific sectors. What's the latest on how they're influencing global trade, specifically in the steel industry? And what measures are countries taking to protect their domestic industries from maybe unfair practices?
Well, the Japan Iron and Steel Federation, along with other key industry organizations there, has specifically requested the Japanese government to implement measures against what they call third country circumvention.
Third country circumvention. Sounds sneaky. What is it?
It is a bit sneaky. It's a practice where steel products originating from countries that are subject to anti-dumping duties, think countries like China or Taiwan in this context, are processed or slightly modified in a third country. This processing is just enough to change the country of origin on paper, allowing the steel to then be imported into Japan evading the original anti-dumping duties.
Ah, finding a loophole through another country.
Exactly. And what's striking and the concerning for the Japanese steel industry is that among the G20 nations, apparently only Japan and Indonesia currently lack comprehensive anti-circumvention systems to stop this.
Really? Only those two?
According to the industry groups, yes. This makes it a critical area for the Japanese government to address if they want to protect their domestic steel industries from what they see as unfair competition and ensure the integrity of their trade policies. It's a reminder that global trade isn't just about setting tariffs. It's also about the constant cat-and-mouse game of enforcement and how companies and countries try to navigate or sometimes exploit those regulations.
Fascinating. Always more complex than it seems. So after this truly expansive deep dive into the latest economic signals and market chatter, what does all of this mean for you, our informed listener, as you try to navigate this really complex financial landscape? What's the biggest takeaway from today?
This deep dive really highlights a fascinating ongoing tug-of-war in the global markets right now. On one hand, we see this incredible resilience and clear growth potential in certain Japanese sectors and companies. That's fueled by both internal economic strength, like that strong GDP data, finally breaking deflation's grip, and external factors like the prospect of those gradual preemptive U.S. rate cuts. This combination is clearly attracting significant capital inflows, making Japan a real standout performer recently.
Right, the positive side.
But on the other hand, there's this constant undercurrent of caution. You feel it everywhere. Whether it's concerns about market overheating in Japan, specific sectoral vulnerabilities like we saw in copper with the ore shortages, or the looming shadows of geopolitical talks, and of course those crucial central bank policy decisions coming up, especially from Jackson Hole. Maybe the biggest takeaway. It's the global game of chess being played by central banks. Japan's economic revival, the Fed's delicate dance with inflation and growth, geopolitical whispers, they're all pieces on the board influencing capital flows. For you, the informed listener, perhaps the insight is this: don't just watch the interest rates themselves, watch the rationale behind them, understanding the why behind policy decisions, the nuance. That's where the real market advantage often lies.
Exactly. And we've seen today just how interconnected everything is, haven't we? From, airfares being affected by social media rumors about a potential earthquake to copper prices being influenced by distant mine accidents in Chile and Panama. It really underscores the importance of looking beyond just the headlines. You have to understand the underlying drivers, the nuances, and sometimes those unexpected connections between seemingly disparate events. The market is so dynamic, and understanding these forces at play is just paramount for anyone looking to stay truly informed.
Precisely. The key takeaway message is that even as markets reach new highs and present exciting opportunities, investors are navigating a landscape filled with both significant potential and very real uncertainties. Staying informed means understanding these nuances, connecting the dots between the big macro trends and the micro-level company stories, and being prepared for potential shifts, because things can change quickly. Thank you for joining us for this deep dive into the latest financial developments. We hope it's given you some valuable insights to consider as you navigate your own financial world. From all of us at ZZ Financial, we are dedicated to providing the most accurate, valuable, and timely information and analysis. Goodbye for now.